This is tax landscape in the Indian and global context. And I am Raghav Gupta. I am an Indian Revenue Service Officer of the 2012 batch. I hope I'll be able to move further than this introduction. Before this, we will again quickly look at what the webinar is going to look at, the overall overview. And the webinar will look at these points. Firstly, it will look at the need for tax, what tax is really used for, what is the purpose for tax. Second would be the tax utilization in India, which areas is tax actually used in India. After that, we'll be looking at the positive feedback of taxation, which means that there's a mechanism of something called the positive feedback mechanism and how taxation is linked with the economy with that mechanism. Next, we'll be looking at the relationship between taxation and sustainable development. And then we look at the challenges of tax evasion and the various modes of tax evasion, followed by some techniques of tax evasion, let's say like tax havens, money laundering, shell companies, etc. And then we'll conclude with the road ahead and the response to COVID 2019. So without much ado, we'll start with the need for tax. And the need for tax can be summarized into three broad categories, according to me. The first one is raising revenue for public expenditure. And this is single most largest reason for having taxes, because ultimately this is the resource or the domestic resource which a country has for meeting its public and government expenditure. The second reason or need for tax is the social contract between citizens and the government. Now, what this essentially means is that the government levies or imposes tax, and in return, makes development for the citizens, increasing their growth and prosperity. The third reason or the third need is resource mobilization, and this can be looked at in two categories. The first one is called incentivizing positives. What this essentially means is that if there's something good for the economy, taxation can help to further channel it, and this can have a runway positive mechanism. And examples of incentivizing positives could be gender equality, for example. A taxation environment which could help promote, let's say, self-help groups in which women entrepreneurs are trying to do something new, can help them rise in both the social as well as the economic sector. At the same time, you can have, let's say, incentives of export-oriented units. This can help homegrown industries to get, better revenue. And you can even have incentives for infrastructural facilities, which again promotes infrastructure of the country. On the other hand, there's another mechanism for resource mobilization, which is dissuading negatives. And this way, let's say you can have a higher tax for something which is not exactly great for the economy. For example, you could have a green tax levied on activities or issues which are leading to pollution or something which is against the environment, etc. At the same time, it could even be levied for items like cigarettes, for example. So these are examples of dissuading negatives, and all of these three needs or purposes for tax are found almost everywhere in the world. So now we look at how tax is utilized in India. And again, as I said, that this is a multi-sectoral, multi-dimensional area where you have literally everything, forming part of the economy. So at the center, we have tax revenue, which is the source. And now we look at various areas where tax is utilized. The first one being defense. Now, defense would include the maintenance of existing inventory, procurement and research of new ones, and also includes border infrastructure. So you can imagine how crucial tax is when it is directly linked or directly funding defense mechanisms in the country. Next, we have science and the funding of scientific research, which can range from the Indian Antarctic mission to the latest biotechnological developments, and even to giving grants to various scientific institutions, scientific programs, etc. All of that is ultimately funded by tax revenue. The next area is infrastructure. Now, infrastructure, again, is a very broad sector. It can include building roads, to highways, to rural electrification, to dams, everything, and even railways. So all of that infrastructural facilities, which are the backbone of any country, are actually funded by taxes. Next, we have law and order. And law and order, again, is a very broad term. It can be looked at the local level, where you have public safety, or at the macro level, where you can have something called financial fraud, etc. And you need watchdogs for that. For instance, the entire tax system in India is also actually funded by taxpayer money. So this is a feedback, another example of feedback. Then you have space and telecom sector, and space would mean, Indian space research mission, which could mean Mangalyaan, Chandrayaan, which have been sent to space. It can include various satellites used for telecommunication, geoinformatics, etc. All of that is again funded by tax revenue. Next, we have agriculture. Now, agriculture is essential for the country because of the large number of workforce which is employed in the sector, and the various methods in which tax revenue can help this sector is giving financial assistance to farmers, helping in seed development, helping in anti-desertification measures, or even in meteorological data monitoring. All of that can actually help farmers develop and generate more income. The next one, of course, is industry. Industry, again, typically the homegrown industries in India can be given a fillip by using tax revenue. And that can be through subsidies. And as I said earlier, through, let's say, export-oriented units, which are, let's say, placed in special economic zones, for example. So these are examples of how tax revenue can actually be helpful for developing industry as well. The next one is finance. Now, finance, again, is a broad term. And this includes various national and international projects, and also maintaining forex reserves, supporting various PSUs, nationalized financial institutions, etc., and also helping the socioeconomically weaker sections. So, for example, funding the poverty, etc. Next, we have disaster management. Now, this again is a very crucial term, particularly when we look at floods, or we look at landslides, or earthquakes, or even pandemics. So, disaster management is a broad umbrella term, and again, tax revenue can be used for disaster management as well. Next is poverty alleviation. This is extremely crucial, and this includes areas like employment generation, rural electrification, again, housing programs, direct benefit transfer programs, subsidized food through the public distribution system. So these are examples of how poverty itself can be addressed by using tax revenue. Next, we have health, and health again includes a variety of factors, being government hospitals to medicines to vaccine development, particularly in the current context. So health is also funded largely by tax revenue. And lastly, we have education, which is last but not least, and it essentially helps in building the human resources of India. That can range from basic education to higher education to online platforms like the one which we are talking about right now, is actually all funded by a lot of government revenue coming from taxes. So now that we know what broadly tax is utilized in, we'll talk a little bit about the positive feedback mechanism of taxes. Now, essentially, a feedback mechanism or a positive feedback mechanism is the one in which the output reinforces the input. Probably it sounds a little technical, but when we look at this loop, we'll understand how. So the first step is, let's say, effective tax collection. Let's assume that effective tax collection is a given, and we start with that point. What does that mean for economy? It means it will lead to better socioeconomic and physical infrastructure. This is obvious because with the ones which we just discussed, the slide behind, is that the more effective tax collection you have, the more effective allocation of those taxes can be done for development of physical as well as socioeconomic infrastructure. And from that, what happens is employment opportunities are enhanced, which means that people who were not employed or were employed in a meager salary or meager means can now upgrade themselves. So employment opportunities are increased. Collectively, these two, that is socioeconomic and physical infrastructure, along with employment opportunities, will lead to something called overall growth and development, which means that after these factors are factored in, the entire country as a whole will develop. And what would that lead to? Well, the next step is higher incomes. So ultimately, if the entire country is developing and people are transforming their lives by leading better lives because of various opportunities in terms of jobs, in terms of risk, taking risks, for example, you could have entrepreneurs who are willing to take risks in a stable economy, then all of that collectively will lead to higher incomes. And you might guess the next step, higher income would mean deepening and widening of the tax base. Now, these two terms, deepening and widening, can be a little tricky for the uninitiated. Deepening means the existing tax base, which means that the people who are already paying taxes would be able to pay more taxes because of higher incomes, better economic generation, etc. And the second point is widening of the tax base, which means that the people who were not already in the tax base would get included now and would be able to contribute to taxes. And this completes a circle by getting back to effective tax collection. So as you can understand that each of these particular points in this loop actually, reinforce each other, and you start off with any one point, you land up increasing the others. So being the tax administrator, our responsibility is effective tax collection, which we know forms a very important building block in the positive feedback, which we just discussed. Moving on to something called taxation and sustainable development goals. How are they linked? Now, sustainable development, again, is a concept which many of you might have heard. Essentially, it means equitable and reasonable usage of resources so that they don't run out and they can be recycled, reused, and hence, lead to a more stable economy overall. So how is taxation linked to SDGs, or the Sustainable Development Goals? Before that, we'll talk a little bit about the United Nations Sustainable Development Goals. And these are many. As you can see, there are about 17 goals. And since they're so important, I would actually take a minute to read them out. One is no poverty. Next is zero hunger, good health and well-being, quality education, gender equality, clean water and sanitation, affordable and clean energy, decent work and economic growth, industry, innovation and infrastructure, reduced inequalities, sustainable cities and communities, responsible consumption and production, climate action, life below water, life on land, peace, justice, and strong institutions, and partnerships for the goals. So as you can assess, these 17 goals are very wide-ranging. They literally cover everything, every human dimension possible. In fact, even beyond human dimensions. So the task is very ambitious, but as they say that only when you can have an ambitious goal would you do something to achieve it. So these 17 goals form part of the 2030 agenda of the United Nations, India being a party to it, which means that essentially all these countries who are part of the United Nations would now work towards achieving these 17 goals by 2030. And as you can see, many of these goals are interlinked, so they have linkages amongst each other. For example, climate action and let's say life on land, they are intricately linked. At the same time, you have no poverty and zero hunger, which are again linked. So, we can't see these goals in isolation, and one might actually ask, how do we achieve these, far-fetched and, very grand-sounding goals? The reason is you have targets. Each of these goals has specific sub-targets and numbering to about 169 in all, and they sort of quantify, they have specific targets of exactly what we need to do to achieve that particular goal. So essentially, that is how the Sustainable Development Goals work, and this is an upgradation over the Millennium Development Goals, which was pronounced earlier. And role of revenue, well, now you can appreciate how important it is, because each of these sectors, at least most of them, are directly linked with government funding and something called domestic resource mobilization, DRM. So DRM is essentially derived from the homegrown resources, which is tax revenue. So only when you have a robust tax system would you be able to achieve these goals, which range from poverty to climate change. Now that we have talked about tax collection, we talk about something called tax evasion. And tax evasion essentially is non-payment of due taxes. But before we move on to tax evasion, there's a spectrum of tax-related or non-payment of tax-related terms. Some of them are harmless, in fact even encouraged, and some of them are outrightly illegal. So the first one is called tax planning, which is something called, which is permissible by law, and it includes typically deductions, exemptions, and allowances. So this is usually looked at lower scale, maybe at the individual or let's say a partnership level. And this typically means that you're saving taxes by, legally allowed and in fact legally encouraged situations like these, the ones which I mentioned. This could even include investments or medical or life insurance, for example, and claiming deductions thereon. So essentially this again is contributing to the overall well-being of the individuals. So this is fine. Next on this spectrum is tax mitigation. There's a very thin line of difference between tax planning and mitigation. One might even say that semantically speaking, they are identical. And in fact, this is also permissible by law. The only tangible difference which I could probably say is that this is at a larger scale. So probably for corporates, bigger organizations, bigger entities, which means that they could be adopting again deductions which are permissible by law. And this could include industrial units being set up in SEZs like the one we mentioned earlier, or a particular industry which is into renewable energy, for example, solar, wind, or energies like that. They can also claim deductions over a given number of years, and even charitable institutions. So this is part of the deductions which these organizations can claim, and this is also legally permissible by law. What happens when we move one stage ahead? And that is called tax avoidance. Now, tax avoidance, by its very definition, is a gray area. there are a lot of loopholes associated with tax avoidance, and some people are, some countries in fact do not define tax avoidance very clearly, and the reason is because of these loopholes. Utilization of these loopholes by for achieving a tax mitigation, or rather tax avoidance as to say, is basically prevented by plugging these loopholes, and that can be done by two major group of rules called the anti-avoidant rules. The first one is called the specific anti-avoidant rules, called the SARs, and the other one is called the general anti-avoidance rules, called the GARs. So together, these rules are gradually getting incorporated in various statutes all over the world, and this is part of the OECD BEPS, that is the Base Erosion and Profit Sharing project by the OECD, which is an international organization based out of headquartered at Paris. And these best practices to avoid tax avoidance are being followed across the world. And the next stage, and the final stage, is tax evasion. Now, tax evasion per se is illegal, outrightly, and most statutes in the world, including India, list it as a criminal or a punishable offense. So here we'll take a pause and look back into history. And as you can see in this newspaper cutting, this is from 1931. And this is about a gangster called Al Capone. Some of you may have heard of him. And he was based out of Chicago. And many earlier movies were based on the gangsters of Chicago, etc. And well, he literally had every negative activity to his credit, be it robbery or racketeering, being bootlegging, etc. And somehow the feds were not able to catch him, largely because, well, there were no witnesses, or there was a lack of evidence, and sometimes the offenses which he committed were not really federal offenses. So there were these variety of reasons when he couldn't be really caught. But one thing caught the attention of the government authorities there, and that was tax evasion. So this is a story of 1931. Coincidentally, this day when he was sentenced for 11 years of prison was also the day when Thomas Alva Edison, the inventor of the light bulb, died. So you can imagine how long back into history we are talking about tax evasion. Probably one of the areas of modern tax evasion when we saw it as a modern crime, and Al Capone ultimately was sentenced to prison for 11 years. So when a variety of crimes which he had committed could not be traced, but thanks to tax evasion, which leaves a very robust paper trail, we were able to sort of nab him and sentence him to jail. So that is a history for tax evasion, and now we look at various modes of tax evasion, how tax evasion really occurs. So broadly speaking, tax evasion can be classified into three broad groups. The first one is called overstating loss or misreporting the expenses. The second one is understating the profit or misreporting the income. And the third is profit shifting or manipulation. Now, this is not a very fixed criteria. A lot of modes and methodologies followed for tax evasion could be falling in the other one as well. So this is largely what is observed in tax evasion. The first one is bogus billing or invoicing. Now, this means essentially that you raise a bill for an expenditure which was not actually incurred. And this ultimately has the effect of reducing your net income and hence taxes thereon. So this is one of the most common methods of actually misreporting your expenses. The second one is called non-business expenses. That is, if, for example, you incur a particular expense which is not exactly related with business, and yet you claim it to be an expense which was met for business, then it ultimately leads to something called reduction of your taxable income. Then we move on to understating profit, and this probably is the most abused area for tax evasion. The first one is called mischaracterization of income, which means that if an income has been accrued to you, for example, you earned some income or generated it, but now that it has to come into your books, you mischaracterize it. You show it as, oh, that's not income. It's a loan, or it's a share premium or a share capital. So essentially what has happened is you've changed the very nature of income and hence not paying taxes thereon. The second could be claiming false deductions or incentives, the ones which we talked about in the couple of slides before. There are several deductions available. For instance, a charitable institution has various deductions available to it. But what happens when it's not really doing charity? What happens when it's not actually doing those purposes which it has legally declared to do, and yet it is claiming those deductions? So, well, this is an example again to show that how claiming false deductions can actually lead to a drop in your taxable income. The third is concealment of income and assets. And this is pretty straightforward. You do not disclose that particular asset or income which you have earned, and hence do not pay the taxes on it. And the next one is also related, which is not filing your income tax return. which essentially means that if you have earned an income and you are above the tax slab and yet you're not filing your return and hence not paying taxes thereon, that again is understating or misreporting your income. The next is profit shifting and manipulation. Now, this is a gray area. This probably comes under tax avoidance in certain contexts, but since we're talking about the generic idea of tax evasion, we'll deal with them here. The first one is called treaty shopping. And treaty shopping essentially means that, let's say, this typically involves three jurisdictions, three countries, in fact. Let's say country A is where your taxpayer is actually belonging to. It could be a company, it could be an individual. Let's say that's country A, which is called, let's say, the home or residence country. And then you have country B, where the actual income has been generated. So that's the source country. That's country B. And typically, what would happen is that before before taxes are actually paid by these countries, there is some sort of an agreement between these countries called the Double Taxation Avoidance Agreement, DTAA. And because of that, the taxpayer can be assured, okay, that he'll be either taxed in A or in B or proportionately in both. But what happens when the taxpayer wants, okay, I do not want to pay taxes at all, I want to avoid them altogether, then he might choose a country C, where there is extremely low taxation. And what has happened is he will take advantage of the treaty between B and C, or A and C, and hence be able to shift his entire transaction to country C and not pay tax thereon. So this is an example of treaty shopping. The next one is called transfer pricing abuse or transfer mispricing in some contexts. What this essentially means is that, let's say you have two independent enterprises, you would expect them to transact in a particular way. But what happens if there are two enterprises which are related to each other by, let's say, management or control or by some other context? Would we expect them to do the same kind of transaction which an independent one is doing? We should, because that's what is called the arm's length price. So the moment the arm's length price principle is violated, this seems to be a violation of actual tax evasion, because what is going to happen ultimately is that because of transfer mispricing, the transaction which would have normally occurred between two independent enterprises is now being occurred at a rate which is different, which will ultimately lead to lower payment of taxes. So this is also an avoidance strategy. So now that we have covered a lot of modes of tax evasion, we look at some interesting examples of how tax evasion is actually achieved in various scenarios. The first one is called shell companies, and you might note that the slide says misuse of shell companies, not just the menace of shell companies or etc. Because shell companies by themselves are harmless. Shell companies are also called as paper companies or briefcase companies. In the Indian context, they might be called dabba companies, for example. And what this essentially means is, now that we don't have a very clear definition, we do know that there are certain characteristics which sort of are common amongst most shell companies. That A, they do not have economic or business activities running in them. B, they typically operate from a small office, and that small space is the address for very many shell companies. And C, they might have directors who are not really doing any business. They're just there to sign certain papers and file company returns, for example. And that broadly constitutes what a shell company is. The question is, how are they misused? So this scheme, we'll understand how shell companies are literally used for tax evasion. Let's say we have unaccounted cash, which means that a source, a company or individual or some entity generated some cash and does not want to pay taxes on it. So what does that person do? Well, he routes this cash to either an offshore entity, which means outside the country, or to a domestic entity. And that briefcase there, basically means it's a shell company. So what has happened is that he's introduced this particular cash into the shell company. And the next step is called layering, which means that now that particular shell company, the parent shell company, would transfer to the other and more. And what this essentially does is that the fund gets broken into pieces, scattered into various shell companies, and now it becomes a difficult trail to understand. What happens next? Well, the multiple layers of these shell companies are able to contribute into the banking channel and ultimately back to the source entity. And when this funds are going back to the source entity, they are typically mischaracterized. The one which we discussed before in the previous slide, they are mischaracterized as either loan, or it could be characterized as a share premium or share capital, etc. There are several examples. So what has ultimately happened is the source entity's own cash has been routed through these shell companies which are not doing any substantial activity and ultimately goes back to the source entity. And this is a big menace. And essentially, this is how the cycle is complete. The source entity generates cash, moves through these shell companies, and is routed back into the books of the source entity. So that's the example of shell companies. The next we look at is tax havens. And tax havens are typically very interesting looking, jurisdictions. Many of these are countries which are fantastic beaches. They are amazing tourist destinations, but they have this dark secret hiding behind them. And we look at certain characteristics what they are. The first one is reduced taxation. These jurisdictions typically have very low or almost zero tax rates. And if you might recall the one which we discussed in the tax evasion slide, some countries thrive on this. And how? Well, this is a method to attract investors or people who have excess funds and who do not want to pay taxes on those funds. So, well, they would park these funds in these jurisdictions. So, and essentially what would happen is, how would this jurisdiction gain? Typically, these jurisdictions or these areas do not have any substantial economic activity, let's say like manufacturing or mining, etc. But they do have two important industries. Usually, the one is called tourism, which is, as I said, the other one is banking. So essentially, their banking channel or their banking sector is very highly developed, which means that if a large amount of fund is parked in these countries, then a correspondingly large amount of interest is earned by this country, and that's how, in fact, a large percentage of the country's own economy is generated from these funds, but at the cost of the tax being evaded. The third characteristic, again, is related to these, is financial secrecy. Many of these countries, as I said, are having those banking laws which are so opaque that you're not able to identify who is the person behind those funds. And hence, there's a secrecy involved. The KYC norms are very stringent in the sense that nobody can easily procure them. This provision of statements is, again, very important. And again, the privacy is extremely important and respected in these jurisdictions, and it gives sufficient cover to tax evaders. And the last characteristic is ineffective exchange of information. And as we talked about the DTAAs, the Double Taxation Avoidance Agreements, these have a special article called exchange of information, which essentially means that if two people or two countries have signed a DTAA, or another term is called the Tax Information Exchange Agreement, TIEA, then they will be able to exchange tax-related information amongst them, which means that, let's say, a taxpayer moves from country A to country B, and country A wants to know, okay, what is this person earning in country B? And if there's some kind of evasion of taxes, then country A, through proper channel, can request country B, and they will be obliged to provide information, provided they are signatories to a bilateral treaty. In fact, some of the exchange of information works in a spontaneous way, and some of it works on a request to pay. So those two methods are actually difficult to achieve in tax havens, because typically they do not have these treaties signed, or even if they do, they have these various conditions which are difficult to meet. However, as I said, the OECD BEPS project is now underway, and several treaties have been signed. India, for instance, has signed about 100 treaties with various jurisdictions across the country, across the world, and we can request information, sensitive information, which is to be treated very confidentially and accordingly brought to tax. So that is an example again of tax evasion. Next, we look at money laundering. Now, money laundering per se is not exactly tax evasion, but it could involve tax evasion, and we'll understand how. Well, money laundering essentially is the routing of money obtained through crime or illegal activity and camouflaging or hiding its source. And such crimes, the crime which has been committed prior to money laundering, is called the predicate crime. So which means that money laundering is the routing of those funds, and that itself is an offense. But before that happens, something else has happened, and that is the predicate crime. That is, you commit a crime, and the proceeds of that crime is then routed. So you're committing two crimes: A, the predicate crime, and B, the crime of money laundering. So examples, of course, would include things like smuggling of banned material, robbery, sale of prohibited items, undisclosed foreign income assets, etc. And routing of this money ultimately is able to disguise the source and distance the source from the funds. We'll understand this through the diagram here. There are three stages involved in money laundering. The first one is called placement. Now, placement essentially means placing of the funds which have been generated, or they call the proceeds of crime. So the proceeds of crime which have been generated from an illegal activity are placed into the financial system. And how is this achieved? There are a number of ways. We'll look at them. The first one is called using an alternative remittance system, which is also called the Hawala or the Hundi system. Now, Hawala Hundi system is an unregulated system and not necessarily something bad, but when it is used for money laundering, it can actually abet to something bigger, something more serious. And what this essentially means is that without actual movement of those proceeds of crime, you are able to send that money at the desired location. So, for instance, this could be done at a domestic level, which means in the country, or it could be done outside and without actual movement of cash. And how is this achieved? Well, the person A gets in touch with the Hawala operator, let's say X, and gives him the money. X contacts his own network Hawala operator Y, who is in location B, which is your desired location, and tells him, fine, credit this particular amount in that other location. And that is done. Well, how is this done? Well, they have accounts, they have their own trust system, and that's how this entire system operates. So this is a dangerous system because within seconds, without actual movement of cash at light speed, we can transfer cash. But all of this is illegal. The second category of placement is using foreign banks, and this is again self-explanatory. You could have certain foreign banks. You can actually place cash in them, and it could be a tax haven. And for all we know, that location would be hidden, and the source of funds would again be hidden from view. The third is called offshore companies and tax havens by using trade-based money laundering, which means that you disguise those particular funds as if it is a trade proceed, whereas actually it's not. And this can be achieved by over-invoicing or by, again, parking into some other country. And eventually what has happened is that the funds which were generated in country A through the garb of trade are transferred into some other country. The fourth one is called smurfing, which means that you are just depositing amounts which are below the threshold limit of due diligence, which means that the banks would not be able to trace or would not find something suspicious in when you are depositing that particular funds into the bank, and by bit, those entire funds can be transferred and then siphoned off to some other place. And last but not the least is making the cash appear as if it arose from a legitimate cash business. And the prime example for this was laundry washes, where we talked about Al Capone and the mafia times. That exactly is where the term money laundering actually came from. Laundering came from these laundromats or these car washes or laundry washes, etc. And these are cash-based businesses. So what you do is you set up this as a front, and instead of earning, let's say, X amount, you earn 10 times that, because ultimately all of that dirty money is being routed and placed into the system in the guise of a front, which is a laundromat. And of course, you can have other examples of such cash businesses, let's say like casinos, for example, and these businesses can be party to money laundering by depositing such funds. So the bottom line ultimately of placement is that the funds have been placed obscurely, and now we come to the next stage, which is layering. Layering, which means essentially is that this particular fund, which has now been placed into the system, would be rotated again and again using any of these methods in order to distance the source from the funds. And you can see there's a washing machine, part being shown there. This is again part of the laundering process. Bit by bit, you're cleaning that dirty money by using it as a washing machine. And that's again another interpretation of what money laundering could mean, because the origins of the terms are not very clear. So it could mean that it started from laundromats or laundry washers, or it could mean that the layering of funds, because of these cleaning at every stage, so to say, achieves that desired intent of distancing the generation of funds to the actual funds where they are right now. And the next stage is called integration. Now, integration is the last stage, and where the funds which have been placed, layered effectively, are now used to purchase, various items, like say land, or cars, or jets, or houses, or etc. Or it could be parked elsewhere, etc. And even taxes may be paid thereon, which means that essentially the white shirt there is actually dirty. Dirty laundry has been cleaned into white. And this is what completes the cycle of money laundering. You did a crime, and that has now generated certain proceeds of crime which have been effectively layered, distanced from you, and you get them back either as assets or you pay taxes on them, and hence allay any apprehensions that this could be something fishy. So now that we talked about evasion and the various challenges it poses, and we talked about development, how do we sort of have a balance between them, and what is the road ahead? So, well, broadly, I would like to talk about three areas where the road ahead is. The first one is artificial intelligence and e-governance. And this essentially means using technology-driven solutions to enhance various fields such as tax monitoring, revenue forecasting, intelligence gathering, and more importantly, service delivery to taxpayers, which includes refunds, grievance redressal, note rectifications, faceless assessment, faceless appeals, etc. All of these are actual components of artificial intelligence and e-governance in play. And all of this essentially means that you're balancing both things. At one hand, you're comfortably having a tax certain atmosphere without any grievance to taxpayers. At the second end, you're ensuring that tax evasion is checked. So this perfect balance can be achieved through technology driven solutions, including blockchain, artificial intelligence, etc. The second point is OECD and the BEPS framework, which we talked about briefly, and international cooperation, which is, India has been an active part of all these, international organizations and has, actively signed various agreements. And this has effectively made sure that India is moving in the region of best practices, which are followed throughout the globe. And the BEPS project has several action points which are at various phases of implementation, both globally as well as in India. And these include something called the mutually agreed procedure, or the MAP, the exchange of information, which we talked about, and also addressing the digital economy, which is a growing challenge. So effectively, why do we need to be sort of aligned with the OECD BEPS framework is because it will help to have a stable international policy, it will have a positive investor atmosphere, and it will balance forex reserves with reduced litigation and minimizing revenue loss, all of them at once. And the third point is effective tax administration, which again is sort of self-explanatory, and it follows from these 2 points. And it essentially means deepening and widening of tax base so that maximum number of citizens are able to contribute to the development of the country, having various taxpayer-centric services, building public trust, positive perception, and effective methods to deal tax evasion. So these 3 broad areas would effectively lead to sustainable development. And how is that? Well, these 3 factors would be helping in equitable resource mobilization, enhancing tax certainty, improving revenue collection, and self-sufficiency. So all of that will ultimately lead to sustainable development as the ones which we talked about in the United Nations goals. So an example, in fact, of sustainable development is how the department has responded to COVID-19. Well, the first one, it has extended statutory deadlines, including filing of income tax returns, the filing of the tax audit report, linking of PAN and Aadhaar, last date of making payments to claim various deductions, and extension of the Vivad Se Vishwas scheme, etc. These are examples to help, minimize the shock which has been promulgated because of COVID. The next is reducing taxes and statutory rates. Various TDS rates, TCS rates, that is tax deducted at source and tax collected at source, have been reduced. The third one is deferring tax and statutory payments. Well, because of extension of statutory deadlines, automatically the deadlines for payment of tax, etc., have also been extended. The next, of course, is processing refunds expeditiously. In fact, the figure, which is of 29 September, a couple of days back, is 1,18,324 crores of refunds, which have been paid to nearly 33 lakh cases from 1st April 2020 to 29 September 2020. So you can imagine the kind of quantum which has been injected back, and this is increasing liquidity, particularly because of the economic shock of which the country is facing. The next, of course, is safeguarding health and safety. And this includes, staggering of work, encouraging work from home, having a roster system to ensure that, not everybody comes to office together, and, encouraging social distancing, having the Arogya Setu app, which is mandatory for everybody, etc. Now, what these measures have essentially done is habituated both the taxpayers and the department employees to follow best practices and ensure that, they are able to meet the challenge of COVID. The next, of course, is relaxing procedures for employees. That various procedures for leaves and for appraisal reports, etc., have been relaxed to a certain extent and provide respite. The next is promoting sensitivity towards citizens, which means including various measures such as reducing interest on payment of taxes and penalties, and also encouraging electronic communication as far as possible. So this has helped towards being sensitive towards citizens, and we have sort of avoided them to call them in person, etc., and have made compliance easier by usage of electronic communication. The next, of course, related to that is minimizing physical interaction. And this, of course, includes, the faceless assessment, the faceless appeals, and the overall preference, again, for electronic communication. The next is staying compliance requirements, and this includes deadlines for various orders and notices which have been extended. Besides the staying of the GAR related and the GST related clauses in the tax audit report, that also has been stayed for the time being. And last but not least is ensuring overall well-being with the COVID stations, which are the COVID teams which are there at various stations and helping to streamline the process of admission in hospitals, etc., have been set up, and all of that actually helps to combat the challenge of COVID-19. So this is a classic case study to understand how tax systems can actually help in a positive way to help development and help overall well-being of citizens as well as employees. So there are certain readings which I would like to suggest, and no, they are not books, they are movies. The first one is called The Laundromat, and this stars Meryl Streep, Antonio Banderas, Gary Oldman, and this is a classic available on Netflix. And this actually explores the theme of money laundering and how the Panama Papers leaks, which some of you might have heard of, were actually came to being. The next one is Raid. This is an Indian movie and you should definitely watch it, and this will give you insights of how financial investigations are actually done in the department, and you'll be able to appreciate what actually goes on behind the scenes. And before we end, I would like to take this chance to acknowledge a lot of people. Firstly, I would like to thank all the participants who are online and who spend their time, particularly because this session kept getting delayed of technical snags. And of course, I would like to thank Team NPTEL, especially Romi, Shribalaji, Mahesh, etc., who have helped me and set up this amazing presentation. The next, of course, I would like to thank tax practitioners who have helped, who have had spirited discussions with, and particularly at the Merchants Chamber at Kanpur, who are here hearing me now. I would like to thank my family and friends who have always been there through my trials, trepidations, and all endeavors, and friends who have been, my support system. And lastly, I would, of course, never the least, but income tax department itself, which has nurtured me to grow as a person and as a professional. And I would like to thank my seniors, my colleagues, my juniors, and various staff who are probably watching this out of obligation. So thank you so much. And for everyone else, these are some of my social media handles. You can reach me out to them if there are any queries, any questions. I'll be more than willing to answer them. And definitely follow the Income Tax Department India at Facebook and Twitter for the latest updates of what the department is up to. Thank you so much, and wish you a happy Mahatma Gandhi Jayanti for tomorrow. Thank you.